Well, a very good morning, ladies and gentlemen, and can I say straight away what a great pleasure it is to be invited to chair this really, what I'm sure is going to be an interesting discussion on the evolution of the UK regulatory landscape. As Miles said, I'm Chris Hayward. I'm the policy chairman and the political leader of the City of London Corporation, and we have a very strong relationship with the City UK and have done since its inception, borne out by the fact that I also serve as its deputy chair. So I'm going to ask our panellists a few questions this morning, and then it'll be over to you for questions from you. So do please think about those questions, get them prepared, and I'll try and bring as many of you in as I possibly can at that time. By way of a sort of few words of introduction from me, proportionate regulation is critical to the United Kingdom's success. It can help provide stability and build trust, and we've seen that with FDIs over the years. And if you get it wrong, of course, you can deter investment. Get it right, and of course, it can help enable economic growth, which is what both of the major parties are seemingly proposing in this general election. So it is absolutely vital that the United Kingdom gets regulation right. And a big part of that, of course, was the recent Financial Services and Markets Act. And in the City of London Corporation, we campaigned hard for the secondary objective for the regulators of competitiveness and for the FCA and the PRA. It was an important step forward in establishing a more agile, proportionate and internationally aligned regulatory framework for the UK. Well, we're now almost 1 year on from the Act coming into force, so this is a really good time to be looking at that Act, and very soon the FCA and the PRA will publish their performance metrics against that secondary objective. So with the regulators soon reporting and the general election imminent, it's a good time, as I say, to be reflecting on this matter. We also heard, of course, this morning, first thing, a clarion call from the chair of City UK that responsible risk-taking should be on the table. Risk should not be a dirty word in financial services, as without it, economic growth will not be possible, we were told. We need to ensure that our regulatory framework engenders responsible risk-taking in financial services, and that's one of the things I'll be exploring with the panel this morning. And what a panel I've got, a stellar panel of experts who will cover these subjects for us. Katharine Braddick, on my immediate right, leads the strategic policy team at Barclays, and of course before that was at the Treasury. Katharine Jane, on my left, is the Co-Deputy Director General of the Guernsey Financial Services Commission. Charles Randell, CBE, is a Senior Consultant at Slaughter and May, and of course, very significantly for this discussion, a former Chair of the FCA. And Donna is the International General Counsel at Citadel. So we've got lots to discuss this morning, not a lot of time to do it, so let's get straight on with it. I'm going to start, Katharine Braddick. I've got two Katharines, so I'm going to do my best not to muddle you up. But Katharine Braddick, I'm going to start with a question which I'll then put to the rest of the panel as well. What are your reflections on the changes the Financial Services and Markets Act has driven, if any, and how would you build on the foundations that it's set?
Thank you, Chris, and thank you so much to TCUK for the invitation to be here this morning for this discussion. I'm obviously somewhat implicated in the Financial Services and Markets Act because the work on it began while I was still at the Treasury. So I feel I should disclose that so you can aim off appropriately for what I'm about to say, because I think it was a really successful piece of legislation. But I think that that is a widely held view, and I know Barclays really supported the passage of that bill through Parliament. I think its success was in drawing together what a lot of industry feedback had been telling government for some time about what was required to make our system more fit for purpose, not just after our exit from the European Union, but altogether, actually, and that's very much to be welcomed. The most heavily discussed part of that act is the secondary objective for competitiveness and growth, and I think we're going to talk about that more. My view on that is that we have not yet settled a set of expectations between us about what that looks like when it's being delivered successfully, what the appropriate accountability and transparency around it is. I certainly think that sometimes there is an overemphasis simply on transparency and accountability, which in fact, certainly for the regulators versus Parliament, can make life more complex, make it harder to deliver consistently against objectives than easier. So I think that is, and I also, just to preview my views on that objective, if we do talk about it more, I think we talk too much about competitiveness and not enough about growth. And they are both economic imperatives that we have to confront as a sector in the service that we provide to the economy. I think the other point I would draw out, there are so many, it's a very broad piece of legislation, there are a lot of things we could pick out, but I think the other thing I would say is I would like to see a clearer outcome from the adjustments it made around the operation of the Financial Ombudsman, because I think, like a lot of financial services firms, we feel that the FOS's role is sort of drawn into filling other gaps in the architecture in a way that makes it harder for them, harder for other regulators, and harder for us to operate with certainty. And we would like to see that clarified. We'd like to see that operate really effectively so that the architecture is a bit more transparent and predictable.
Thanks very much, Katharine. Let me turn to the other Katharine. Katharine Jane, what's the Guernsey view?
Well, I probably should say at this point, I am obviously coming from the Guernsey regulator and not from the UK regulators, who I know couldn't be here today. So I'm going to try and not to speak too much for their part and talk about from the Guernsey side. But what I think the Act gave was the flexibility for the regulators and others to move away from following what the Europeans were going for and looking for the differences and things that they could do to enable that competitive, and also, I agree with Katharine, that actual drive for growth that we can go for. Now, in Guernsey, we don't have a secondary objective for competition, but what we do look to do is ensure that as a regulator, we're taking that balanced approach between the ability to take risks, but take it in a controlled manner that means that you've got the right governance and oversight over the process, because I think that's what we're talking about when we talk about growth and risk. Is we're talking about doing it, ensuring that the relevant protections are still in place for people. And I think that's a very difficult line to come to. And I think we'll probably end up talking a lot more about what that line should be and where it sits. But I think the thing we're actually looking at is that discussion and the interaction and the talking between both the industry, the regulator, and other parts of government to ensure that we're in the right place to enable to drive growth with the right protections and controls in place.
Thank you very much. Now, Charles, you're a former chairman of the FCA. What's your view?
Well, thanks very much, Chris. I just, first of all, want to make clear that I'm a former chairman of the FCA, so what you're getting today, because of the election, is a tribute act rather than the real thing, and my views clearly don't represent those of the FCA. My feeling is that we haven't really had the discussion we need to have about what this objective actually means. And you see that in the performance criteria that the government's come up with. It's really all about things that are very important, like how efficient is the FCA's authorisations function and so forth. But what we haven't had is any sort of fundamental discussion about how the financial services industry contributes to growth. And I think there's a bit of an underlying assumption that more finance equals more growth. Now, we have some authorised firms in the UK who have to put on their website the fact that 85% of their customers lose their money when they invest in their financial products. That doesn't lead to growth. That leads to enormous social harm. It leads to mental and physical distress. And it sets the country back. It imposes an enormous burden on our public services. What we need to do, I think, is have a much better discussion about what type of growth we want and how does the financial services industry contribute to sustainable growth. To my mind, that's not a discussion we've really had, and I think there's a great opportunity to start having that discussion now.
Thank you very much, Charles. Donna, finally to you. What's your take on this?
Sure. Well, at Citadel, we trade across asset classes in multiple jurisdictions. Our London office outside the US is our biggest hub. So it's very important to us that the UK markets are seen externally and internally as being fair, transparent, and operationally resilient. That's important for growth. It's important to attract new investment and also retain investors in that market. So therefore, like Katharine at Barclays, we're hugely supportive of the Financial Services and Markets Act and the framework that it's built to enable review, consultation, and implementation of new rules within the UK, really looking at the body of the rules that we've inherited from the EU and seeing whether actually they're fit for purpose for the markets that we want in the UK. So we see this as a very positive step for the UK markets, that we now have a more agile framework that we can operate under.
Well, thank you very much, panellists, for that first round of questions. I think it's probably fair to say you're all in violent agreement with each other very broadly. So let's move on to another question now, and I'm going to be fair to you all and take the contributors in reverse order this time round. Perhaps this is a little bit linked, of course, to the previous question, and it was something that I was asked about when I gave evidence before the House of Lords Financial Services Regulation Committee not too long ago. And it is indeed the question of attitudes towards risk, as I previously mentioned, because there's concern among some of the UK's mindset that is focused on regulating to eliminate risk. So what's your view on this, and how can we drive a greater recognition of the benefits degrees of risk can have to investment and growth, as the chair was outlining this morning? So Donna, let me start with you to take your thoughts on that one.
So I think, putting aside the question of whether it is even possible to eliminate all risk through regulation, risk is the cornerstone of the economy and growth. And so we have to acknowledge that risk-taking is an important factor for growth and investment in the UK. I think it also links to competitiveness, as Charles said. And we have to ensure that our markets are trusted internally and externally, and we have to make sure that we have fit-for-purpose regulation. There's no point in applying safeguards for consumer protection to wholesale markets and vice versa. So I think this gives us the opportunity through FSMA to really look at the guardrails that we want to put in place for the different parts of the market and ensure that they're appropriately tailored. I think we also need to look at risk as well, and in the context of competitiveness, look at other markets and what they are doing as well in order to better control risk. And a classic example of this is T+1, which has just gone live in the US. I think we, as an industry, can look at other global financial centers and see what they are doing well to manage risk. And we can learn from their processes as well and think about how they can apply to our markets. I see that as something that we should be doing. Competitiveness is about us looking at how we do things relative to our other competitors, effectively, for capital markets.
Thank you very much. Thanks for that. So, Charles, talking to a former regulator, as you said, what's the regulator's attitude towards risk? I mean, we were talking beforehand about some people suggest that we need a markets regulator, etc. What's your take on how can regulators be innovators?
Yeah, I think regulators have been innovators. I think the FCA had a great reputation for a lot of the work that it did to support innovation, and I think as it recovers from its various backlogs around COVID and so forth, it's able now to put more efforts back into that innovation side of its activity. But I think we need to just segment who it is that we're saying needs to take more risk and think about how that risk is appropriately taken. So first of all, I don't want to do more than just grieve for a moment about the defined benefits pension disaster that has been an absolute cataclysm for growth in this country. That ship has sailed, but we do need to think about how to harness pension assets in a way that's going to do the best for consumers and produce them dignity in retirement. And I think there are huge opportunities there, both within public sector pension schemes, like the local government pension scheme, but also in private pension schemes, defined contribution and other schemes to consolidate, be efficient, and have appropriate allocations to higher risk assets. So that's one thing we can do. When it comes to retail investors, I think it's very important for organisations like the City UK and some of the other people who've been talking about how to deal with this to remember that there's a bit of a danger that people talking about financial regulation have a hammer and everything looks like a nail. And you need to work out why is it that UK households are not investing more in the equity market. And it's not because of FCA rules, by and large. It's, first of all, compared to the United States, UK households have about a third of the wealth. Secondly, that wealth is predominantly pushed towards housing assets in this country. They're very expensive. There are a lot of incentives to invest in housing assets, and there's not nearly enough supply. But actually, engaging with retail investors to find out what's putting them off retail investment, I think is quite important, and I think it would be helpful for organisations like this to do, a little bit more work on that. We can change the message. I think to say capital at risk, when actually your capital is at risk in a high inflation environment when you leave it in a bank account, is potentially giving the wrong message. And we need to think about, if we're going to have people investing more in equities, do we have the right products to provide the right risk and return for them after costs? So I think there's more that can be done there to make it an attractive proposition. What I don't want to see is an environment in which retail investors are encouraged to go into high-risk assets that are unsuitable for them, because once those people get burned, they stay away from the market forever. And Katharine's not guilty of this, but some of her colleagues at the Treasury, I think, or certainly at the ministerial level, sort of slightly have a magnetic attraction towards, the latest thing, peer-to-peer loans, mini bonds, unbacked crypto, or whatever. You are creating a generation of savers who will never come back after they've lost their money. And so we need to find the right risk return that keeps people sustainably in equity investment for their lives.
Thank you very much, Charles. Katharine, how does the Guernsey regulator incentivise risk, or do they not?
Well, I think we have to look at this and say, if you're operating in financial services, no matter what you're doing, you are taking some form of risk. I have a story where generally a firm we visited at one point said it had no AML CFT risk whatsoever. And we went, we might disagree with you at that point in time. But I think it's about that understanding of risk. And as Charles says, what level we're taking for whom, because there's a wide range of marketplace. And actually there are people there who can accept more risk than others, but it's understanding that education, and I think that's the piece I'd add on to what Charles said there, which is actually this is also about the financial education of the individuals involved. There's a bit about them understanding what risks they're taking, how they're taking it, and that doesn't just sit with the regulator and the protections that they have in place, that sits with the wider education process and the systems that are operating globally for those people who are investing in financial services. And I think in Guernsey, what we look to do, especially as part of our authorisations process, is understand the risks that a firm is taking, what they're talking about and where they're going. And this is especially key, I think, with the new technology that you can see, because there's a possibility, and there's actually probably a certainty with some of the new technologies, that actually a wider portion of people will be able to access a variety of different things, and that actually, if that technology is used appropriately, it could help and facilitate people investing in financial services in the appropriate manner. But I think that's the conversation and the discussion that we have to have, is what is that balance of risk, and how do we have the right protections in place for the people who need to know those things.
Thank you very much. Katharine, the last word is yours on this one.
Yeah, what's left to be said? So So the first thing I would say is that I really strongly agree with Charles that our regulators actually have a track record on this. There's the sandbox, the digital sandbox was a world-leading exercise in creating a safe space for innovation and risk-taking and it was copied all over the world. I really admire the way Nikhil has been very clear in public about how wholesale market reform means altering where risk lies, and that's necessary and it's part of the process. And I think it's really helpful that he's pushed the debate forward like that. We all know that risk is why the financial services sector exists, because it's what it's there to sort of manage and apportion. The thing to remember about the term risk is that it's both very broad and very technical. So we understand what is meant by it in this room and in our businesses, but if you asked our customers, they would say, well, no, risk is your job. I don't want to take risk and I don't have the money to take risk with. We are still talking about risk, but we use it technically in a way that does not communicate if we want to progress this sort of public discourse. There's also, I think, a division between those in the sector who would like to take more risk and feel inhibited from doing so, and that connects with the conversation we were having on growth. And there's a different, there's a different part of the population, the sort of retail part of the population, where the job is really to help people get access to the benefits that effective risk allocation allows for the purposes of their own savings. We're about to walk into a savings crisis in this country. And that's partly to do with pensions reform, but it's also to do with providing a space, a mass market sort of financial guidance space for people who are not going to be managing complex equity portfolios, but have more money than ought to be sitting in a bank account. And we have a generation of savers in this country who are completely de-skilled, and their only available place to go when they're searching for yield is exactly the sort of products Charles was talking about that they should be nowhere near. And we have got to sort out that part of this market if we're going to address this economic problem.
Thank you. Thank you all very much, team, for dealing with that. My third and final question to the panel is going to be around competitiveness, and then I'm going to turn to the audience. So please be ready to flag that you'd like to ask a question. So I mentioned at the beginning of this session that it's now a year since the regulators were given the secondary objective for competitiveness and growth. And we know, of course, the importance of being internationally competitive. I returned yesterday from travel to various G7 countries and to Singapore as well, and it came very clearly to me that the global landscape for financial services is fiercely competitive today. So starting with you, Katharine, Jade, if I may, how do you believe we can build greater alignment between regulators and policymakers to support investment and growth into the United Kingdom?
I think part of it is that, and I think it was mentioned earlier by Donna, looking around and understanding what is happening in the other jurisdictions that we operate, that we are competing with, and looking at it. Guernsey has always been a jurisdiction of choice. We are, and we feed quite a lot into the UK economy in that part, but in terms of people choosing to come to Guernsey, they have to make that choice and they have to understand what we offer. And looking at that, we do quite a lot of work both with the FCA as well in things like the Global Financial Innovation Network, where the regulators look at what is being offered and how can we ensure that we facilitate the best service possible to people coming to Guernsey. And part of that for us is development of technology and the development of a new authorisations platform to enable us to make that process as smooth as possible. And I think the competitiveness aspect and ensuring that we work well together is about having those conversations about what are the things that UK has and Guernsey has that we can build on, what are our strengths, and how do we take those back out into that marketplace to be as competitive as we can. Now that has to be a conversation because people will have different views. But actually if you get industry, the regulator and your government aligned on those processes, it becomes a much more powerful message than one party doing it solo. So if industry goes out and says this way, but the government's going a different way, that becomes problematic.
Thanks very much indeed. Donna, your thoughts?
Yeah, well, I mean, London, as we all know, is centre for a lot of international businesses. And as a result, there is a lot of know-how within these businesses about all of the other global financial centers and how they are doing things and what they are doing. And so, the regulators here have always been very open and partnering with the industry as part of their consultation processes, as part of their policy review and reforms, to get that feedback from industry. And I think that's really key, that that just continues and grows so that we can be competitive relative to the other global financial centers. London doesn't operate in a vacuum. The capital markets are global now. And so we need to know what is going on elsewhere and where things are being done well, and how we can also implement similar changes. And we've seen a number of, already we've seen a number of reforms coming through off the back of FSMA, even in relation to the short selling regulation, and the willingness of the UK regulators to try and simplify some of the operational complexity and the operational burden, and simplify the disclosure mechanisms, looking more towards the US than the EU framework. Again, we've seen a strong commitment from the UK regulators in relation to increasing transparency in the fixed income markets, with a commitment to create consolidated tapes for bonds and derivatives. So we see this as a really strong sort of pathway forward. And as I said, we have to see ourselves in the global stage and look at how other people are doing things as well.
Thanks so much. Katharine, can we learn from the rest of the world?
We certainly can. I think that we've already done, the industry was talking to government about regulators and competitiveness before we left the European Union, but it's clearly, Brexit that provided, apart from anything else, the legislative means to act on it. And since then, of course, the world has changed very significantly. But I do think what the UK authorities have done is demonstrate that, around, for example, MiFID II, when we have control of our own rules, we can make better rules for our own markets that are more efficient. And I think that does create, in a modest way, a sort of positively reinforcing dialogue around the rules, certainly between the UK and EU. When I say dialogue, I don't mean actual dialogue. I mean that they look at it, each side looks at what the other is doing, and it helps with the efficiency of the regime. I do feel, and I also think that it's the comparisons with other jurisdictions can be quite difficult. Singapore is a very different economy than the United Kingdom, for example, and that's one of the most commonly chosen. And the United States actually is a very different environment, and now that I work at a transatlantic bank, I can see the challenges in a US regulated environment as well as in the UK environment. What I would say is, I think we don't yet have a mature set of expectations, a mature way of talking about how these objectives are being delivered. So it does devolve to quite mechanistic measures around efficiency of delivery of certain tasks, and I don't think any of us think that that's what this is really about. And I sort of shot my bolt already when I said I think we talk too much about competitiveness and not about growth. And unless we can, between us and the regulators, make the case for the contribution this sector makes to growth, I think we are going to find ourselves in a difficult environment vis-a-vis our customers and clients who are sort of right in there in the economy and feeling the consequences.
Thank you very much. Charles, your thoughts?
Well, I agree with a lot of what Katharine's said. I'd just like to shout out about Katharine's amazing work on the trade and cooperation agreement that didn't, unfortunately, see the light of day, and that would have led to a much more functional relationship with the European Union than the one we currently have. But that highlights an opportunity that we have to re-engage with our closest and largest market. Obviously, expectations out of those discussions will be low, but I think there's a lot more that we can do to remove a lot of the dysfunction that's there. To my mind, it's really important that the regulators look at the outcomes they're trying to produce. And when I was at the FCA, we set ourselves the objective of a couple of outcomes. One, people who have £10,000 or more to invest should be investing it. In more cases than they do at the moment. Two, more people should have access to support to enable them to understand the decisions that they've got to take. Now, progress on those things is slow, has been slow. But I think if you take that approach, you tend to then focus on the key issues and on the delivery of the key issues rather than being sucked in, as regulators often are, into a sort of cycle of rulemaking. That would be my, my first principle, which is, work out what the outcomes you are, through Katharine's point, work out which of those outcomes actually do deliver growth, and then relentlessly pursue them, and mark yourself against them and be prepared to be held to account against them. Mm-hmm. But that also includes, coming back to my earlier point, making sure that you're not doing that through exposing people to very harmful rent-seeking financial products. It's got to be the right balance of risk that will enable people to stay in the market and invest for the long term.
Thank you very much, panel. Well, members of the audience, I've had my chance to grill the panel. Now it's your turn. We've got about 10 minutes or so for questions. I'm going to take the first question over here with the gentleman with his hand up. If you could just say who you come from, where you come from, who you come from, representing, the microphone will come to you and we will start to take some questions. And please indicate who your question is to on the panel, please. Thank you.
Thank you very much. Nicholas Beale from Citadel, and I think the question is to Charles and to Katharine B, but others may have views as well. Do we need, as a financial services industry, to the extent that I'm part of it, to distinguish, keep in mind the distinction between the growth and competitiveness of the financial services industry and the growth and competitiveness of the UK economy as a whole? And done correctly, these can support each other, but as Charles was indicating, sometimes at the margins they can be in opposition. And are there in fact more opportunities to work with the perhaps new government to articulate very clearly how the financial services industry can really help grow the real economy?
Who wants to kick off?
Well,
Charles?
Absolutely. I completely agree with you that it's very important to remember, and I think the financial services industry occasionally forgets, that the provisions in the 2023 Act are framed in terms of the competitiveness and growth of the UK economy, not solely the competitiveness and growth of the financial services industry, and they can be in tension. I mean, I gave you one example, which is financial products that actually, cause quite a lot of social harm, and the other obvious example that regulators always point to is the fact that we never had quite as much growth in the banking sector as we had in the early 2000s, and we know where that ended up, and we're still suffering from it now. So we clearly need a balanced financial services industry that serves the real economy, and that's the point I'm making, I think, which is that the articulation of that mechanism is incomplete. And regulators have to have a vision for how financial services helps to grow the real economy if they're going to deliver on this objective. And it's partly about whether you answer the phone when somebody wants to be authorised and how long it takes to get their application through. I mean, clearly that is a part of it, but it's a pretty trivial part of it.
Okay, I think there's probably a lot of agreement on that, so I'm going to give somebody else a chance to ask a question. To the gentleman on the front row here, if we could bring a microphone to him, please. Thank you very much.
Peter Wilson-Smith from Meritus Consultants. I was glad that Charles Randell mentioned Europe, because invariably I find at these conferences there's a sort of conspiracy of silence on the subject. I mean, it seems to me this is absolutely critical. We have a clear strategy in terms of what we want to achieve in rebuilding the relationship with Europe. I mean, it hasn't been cataclysmic in the way Brexit, in the way some suggested, but when you talk to people in the big investment banks, they talk about the way business is steadily leaching away to Europe. It's a slow puncture. It's causing immense damage. And I'd be interested to know, what do we need to do to restore that relationship? And don't we need, an overarching strategy for developing the city? I mean, the government set up a series of reviews, some of which come up with some perfectly sensible things, but there's no sort of coordinated strategy or sort of overall aims to sort of frame where we want to be.
Okay, who wants to go on this one? They're all looking at you, Charles, again. I don't know.
Okay. Yeah, I mean, since I've partially retired, my wife says to me regularly, "My goodness, you've got a lot of opinions." And as it happens, I do have an opinion about this as well. I mean, we have to recognise that for the foreseeable future, we're outside the European Union, and we have to recognise that world will not come back. I don't think Paris will be any keener to have asset management firms coming back to the UK. I don't think Amsterdam wants to lose its equities business back to the UK, and I don't think Frankfurt wants to lose the banks back to the UK. That's the way it is. But I think there are areas where we can cooperate. I think the outcome of the November US election may well provide other opportunities for us to rethink where our interests lie and where we're most likely to be able to serve our interests through negotiation. And I think in areas like sustainable investment, which was the subject of the first panel, I think there are huge opportunities for us to do more and to try and avoid creating sort of multiple standards across the world. And there's often actually a last mover advantage in these things to enable you to align more closely with other countries. So I think there are some things we can do, but we have to be realistic that, again, it'll be in the area of marginal gains rather than taking us back to where we were before 2016. I mean, Katharine knows much more about this than I do, so
There you are, Katharine, there's the pass.
Yeah, you flick the switch.
Yeah.
So, I mean, that's absolutely right. It is what it is. I don't think those market access discussions are going to reopen anytime soon, / conceivably ever. But that's not to say that there is not already, actually, in the wake of the Windsor framework, a more engaged relationship between the UK and EU authorities, which is really positive. And my hope would be that, given the commonality of challenges we face in each of these markets, we can really build on that, not to rehash these quite sterile Brexit arguments, but to talk about these shared challenges. So on each side of the channel, we are worried about our capital markets, admittedly starting in very different places. But there is thinking we can share. On each side of the channel, we are concerned about investment into infrastructure. We're concerned about the transition to net zero. All of these are problems for which finance is a core part of the solution. And it seems to me that if we can start to build common approaches for markets that are really very similar, then we may find this whole relationship eases and it creates the trust that does enable us to remove those frictions, which we certainly experience. I certainly agree that our debate has become really inward since we left the European Union. And at a moment when the regulatory sort of framework internationally is also fragmenting, I think that's really unhelpful. Mm-hmm. I think we need to be talking about how to regulate and make policy for markets that are more fragmented than they were at the high point of the kind of post-crisis rulemaking process and supervisory process. So I think there is a lot to be gained, but I also think that a lot of the gain is, if you like, outside the financial services space, in other areas of policy. You know, so this is heavily discussed, so I'm not saying anything that we haven't all read in the paper, but if an incoming Labour government is interested in starting with security and defence, then that means that we're talking about, you know, really shared foundational challenges between our societies and economies that help us get to know each other again and rebuild that trust. And I think that, and sort of fostering growth on each side, which is good for all of our companies, then gives us a basis for these more substantial technical engagements. That's what I would hope.
Thank you very much. Now, I'm running down to a close, but I'm going to, in fairness to those who submitted questions on the iPad, I'm going to pick just one at random and ask each of you just to give me a couple of lines, and we'll go sort of from along this way, along the panel. And it's very topical, really, because it's right in the middle of our general election campaign. And the questioner says, what do you think is the responsibility of political leaders in supporting an appropriately proportionate approach to regulation that accepts the risk of failures without knee-jerk demands that more regulation is the answer or blaming regulators as a stock response? Donna.
Oh, do I have to go first?
Not really, we can go the other way, but no, I think you probably
I think we should start with Charles.
Go on, Charles. We'll work from you work this way then.
So I love the idea of a world in which politicians don't blame regulators for everything that goes wrong. Certainly my phone used to ring when I was at the FCA, and I would find, ministerial advisors on the phone asking for much more blame to be spread around. But I don't think it's a party political point. I think whoever is in power, there will be that moment at 11 o'clock at night where the special advisor is told the minister's going on the Today programme at 6 o'clock tomorrow morning, who are we going to blame? And that, I'm afraid, is the reality of life. So I think regulators need to publish the outcomes they're working towards, be prepared to be held to account against those outcomes, and then develop, even broader shoulders, because I don't think our political discourse is headed back to some sort of, heyday where a few Fleet Street editors, used to meet in the club and decide that, the message was going to be generally supportive of the establishment. That world is gone.
Thank you very much. Katharine.
I'm not sure I can add to that. I would agree with everything Charles has just said. As a regulator, you develop a fairly thick skin. You understand that if things go very, very well, you won't get to talk about it. You won't get to tell anybody that you've managed to prevent this big financial crisis or anything else happening, or a load of people not suffering a financial loss. And when things go very, very badly, you're the first person they turn to. I think all you can do is ensure that you have the right discussion about what that risk aspect is and what was done to try and help protect people. But I don't believe that we're going to live in a world where politicians will not jump on a particular bandwagon.
Katharine, you've worked with a few politicians.
What would I add? So given that we're sort of cleansed of political presence today because of the election, what I will say is that I think the relationship between government and business is degraded very seriously in this country, and I think that does not help. And I would hope that an incoming government with some very serious and important challenges to address in our society and economy will work properly in partnership with finance to understand our role in supporting the addressing of those problems. And I think that kind of dialogue at the margins helps with the Today programme problem and the Daily Mail problem and the TikTok problem, but realistically only at the margins, and that's part of operating in a democracy. So I share the general level of optimism that the fundamental dynamic will shift. I would like to see the risk appetite for policy set less on the backbenches and more in the cabinet, personally.
Okay, thank you. Donna, your last word.
Not sure what else to add around that. I think I would echo Katharine's comments that in the same way that the regulators have had a good dialogue with the industry, I think it's important that any new government really takes time to sit down with the industry as well and really understand some of the challenges and some of the opportunities as well. So that would be my...
Look, thank you very much indeed. Ladies and gentlemen, we could discuss this for a lot longer. Unfortunately, the clock is against me and I've got to bring the proceedings to a close. I hope you'll agree with me that it was a fascinating discussion with the panellists, and thank you for your questions as well. Please put your hands together and give a warm thank you to my panellists this morning. Thank you all very much indeed. Well done. Thank you.